Hi everyone, welcome to another honeystocks.com weekend analysis, and this one's going to be going out at the end of January 2022. Now, before I do the usual and of course switch over to my screen share and walk through all the charts I guess that I have to present today, I've had a lot of questions, emails regarding the broader market. Are we close to a tradable bottom? So what I'm going to be doing is sharing with you quite a few of the charts that I've been sharing with our clients over the last 6 weeks. It has been quite a while since I've put out a video onto social media. The reason for that is simply just way too busy now. I think most of you probably understand that. Now, the charts that I have to present today, I'm going to do my best to just try and explain the key levels in the market, what would be a signal for an entry into a stock, and of course the risk management side of things as well, which for my work is very, very important. A couple of things to get out there just off the bat. I think most of you that follow me on social media and Twitter and you all understand that I'm not a day trader. I couldn't think of anything worse. My time horizon is generally weeks to months. So if that fits your own investment profile, you'll probably get quite a bit of value from it. Just a quick disclaimer, if there's any squeaky toys in the background, if there's any unprompted barking, I've taken ownership of a very small puppy. He's only 10 weeks old. He's frantically shaking a toy to my right at the moment, so apologies, but it is what it is. So let's dive into the charts, let's see what the market's telling us, and hope you get some value from it. Now, before I get into the charts, please, as always, don't be silly, not any investment advice here. Please do your own due diligence. Maybe to give myself just a little bit of credibility, I'm working my way towards my CMT. Technical analysis is something that I'm widely known for in professional circles. In this game, I know that it's very much a case of what have you done for me lately. Back in November, I was highlighting the failed breakout in the small caps. Start of January, my weekly letter, 3rd of January, valuation reset. We've got the 5th of January, I put out the potential for a big failed breakout similar to what we've seen with the small caps. Ultimately that has played out. Back in September, I was advocating getting defensive because of the seasonality. And if you want to take it back a little bit further, back in 2020, I've now posted onto my website the analysis that was provided to our clients to help them get defensive ahead of the crash. As most of you know by now, there's no magical hindsight indicators used with my work. Anything that I'm posting, I do try to back it up with charts. And one thing I absolutely hate is when you have analysts that are posting charts and they're talking about hindsight and how they did this and everything's perfect. I think most of us understand the market doesn't work like that, so I do try to just kind of back up everything that I'm saying. And if you do get some value from my work, feel free to follow me on Twitter, and please do, it's a very small ask, please do give the video a like, share it, subscribe. If you have lots of social media followers and you get some value from this, feel free to share with your followers. It'd be appreciated very, very much. Now, let me just spend 5 minutes just walking through the broader market and why there is a potential, in my opinion, for a rotation back into tech soon. I think the big question that I'm getting at the moment, especially via email, I think clients as well are wondering, you know, are we going to get a bit of a rebound within the overall context of a bear market, or is this going to be another one of those buy the dip corrections? Now, we can see that year to date, you know, if you've been 100% allocated to energy, you know, congratulations. The market under the surface has been completely obliterated. words like corrections and crash get thrown around quite a lot. In my world, I don't really subscribe to the whole, it has to be over 10% or over 20%. You just need to look under the surface, and many stocks have crashed 50, 60%. Some of the mega caps down 40%. So in my view, I view the market as having crashed. Although, if you look at the textbooks, it doesn't say that, but you just need to look under the surface. Now, technology is one of those areas, of course, that I think most of us are looking to allocate. Now, I've been keeping an eye on this chart. Of course, when the S&P puts in the failed breakout, because of the weightings of a lot of the mega cap tech, triple Qs are going to come down hard. Now, in my world, I look for things like failed breakdowns, because we can often get fast moves going in the opposite direction. I'm looking at RSI here. Whilst it is in a bearish range at the moment, we are due some sort of oversold bounce, in my opinion. Now, the real question, I guess, that most have is, well, if we bounce, Sam, is it going to rip higher and make new all-time highs, or is it going to be a short-term bounce followed by a fade? Now, I don't have the answer to that question. So that's where risk management really comes in. Now, for those of you that do follow me on Twitter, you'll know that on, I think it was maybe Wednesday or Thursday, I posted this chart just highlighting that if technology is going to get a bit of a rebound, then this is a logical level for that to happen. Now, ultimately, that looks to have played out with XLK. On Friday, the market had an absolute ripper of a day. I'm sure most of us were relieved, although the market does have some ways to get back to where it was, but it's a good start. I think if the market in tech is going to rebound, then it's doing so from logical levels, in my opinion. But like I said, I don't know if it is going to be within the overall context of a bear market. We could quite easily fade here at the 200-day simple moving average, which is a big part of my work, just as a trend filter, if nothing else. We did put in the failed breakout. It has declined hard, but again, if we start to kind of move higher from the 200-day, then again, that might be an environment where buying the dip now starts to make some sense. Small caps, as I'm sure most of you can appreciate, have just been an absolute no-go zone for a couple of months now, ever since that failed breakout in small caps and then the subsequent breakdown lower. The small caps are absolutely, they're in a bearish range at the moment. It's a really good gauge of market sentiment as well, because when the market's in a risk-on environment, you tend to find that's an environment where small caps are doing pretty well. I think most of us are probably getting a little bit looser with our allocations to small caps, given the 5, 10, 20% gains that they can make in a week. But when you've got the risk sentiment pushing lower, then you tend to find that's not an environment where buying small caps is a winning strategy, in my view. So small caps are completely off the menu for both myself, and it's something that I've been communicating to clients and members over the last few months. And whilst, yes, we would potentially get some sort of oversold bounce, it's very, very key for me whether or not we retest the breakdown level and collapse, or are we going to put in a move higher back into the range and see a similar move to what we got with a failed breakout. Like I said, with failed moves, we get fast moves going in the opposite direction. So for me, small caps would be appealing if it can get above that 210 level. We know the 2000 Russell 2000 growth names have been battered. Again, an oversold bounce is reasonable to expect at this point. So we'll see how that plays out next week. This is one of the charts that I share with our clients on Wednesday, just highlighting a potential support level. and it looks to be holding up okay at the moment. The Dow, the S&P, so they pretty much run in tandem. So if the Dow is going to start making its way back to test all-time highs, you would expect the S&P to go with it. Couple of ratio charts that I like to keep an eye on. This is the consumer discretionary relative to consumer staples. Again, if this ratio is resolving higher, consumer spending is on the up relative to consumer staples, which is really a defensive area of the market. So when this is rising, it's very much a risk on environment, but to the other side of it, when it's declining, it's a very risk off chart. So this is a chart that I'm keeping a very close eye on at the moment. The reason I'm keeping a close eye on it is if the market continues to decline, when we get to these extreme oversold and overbought readings, they tend to tell us that the market has reached a market top or a market bottom. That this is the crash bottom, for example. So when we have these challenging corrective phases, this is one of those charts that I like to keep an eye on, and if we reach this level, then that would be an environment where I'm probably advising clients and members to start buying stocks. So we'll see how that one plays out. The technology relative to the Dow, I'm asked a lot, Sam, in the current environment, should we be looking at buying tech, or is it more of the industrial material names, energy names, etc.? At the moment, I'm keeping a close eye on this chart to see whether or not it's going to be tech or the Dow which is going to be the outperformer. This is a chart that just compares the two directly, and it tells me which one is outperforming. We've got the US dollar index breaking out. I posted this chart, I think, on Wednesday or Thursday to Twitter as well, and lo and behold, it's put in a breakout. So we'll see how that impacts the market. Now, what I'm going to say is I'm about to run through around 20 individual charts and of course names that I think you should add to your watch list. What I would say is that I could change my thesis on 30 seconds notice with some of these charts. Now, as I said at the start, I'm not a day trader. I'm more of a technical investor. If you were to sit and have a beer with me, I'd probably tell you that I'm more of a technical investor nowadays. And these charts could flip in an instant. If the market gaps down 2% on Monday, I can't do anything about that. So please do your own due diligence, because I cannot post every single week to social media to keep updates on my own chart, on my charts. That's something obviously that I communicate to our clients and members on a daily basis, and of course provide analysis to them twice a week. But please do your own due diligence with any of the charts that I'm about to walk through. Now, Apple posted really good earnings in my opinion, and the market looks to have found support at a favourable level, and it's rebounded pretty well. So I think Apple, if you are in the camp that you want to allocate to big tech because it's a safer area of the market maybe than some of the speculative growth tech names, I wouldn't argue. I think Apple makes a lot of sense. I think, for disclosure, I own plenty of Apple. I'm sure most of us have exposure somewhere to Apple. So I'm very, very pleased at what I've seen with the earnings. Again, we've got Netflix. Now, I'm posting this chart not because I think Netflix is a great chart by any stretch of the imagination, but something caught my attention during the week, and it's good old Bill Ackman doing the old Twitter pump. And for me, it makes a lot of sense why he's done it. There's been an extreme overreaction, in my opinion, to earnings. I think the RSI was down at 9. I posted this chart to social media, I think on Tuesday, maybe Wednesday, and it's put in a little bit of a bounce so far, but this makes a lot of sense. I think I like charts where I can very easily define the risk, and I think if you start to break down below trend lines and below lows of the day, then it's very easy to just say, do you know what, let's not take any chances, let's get out. But I think there's a technical support level there. I think this is one of those that, it's more of a hold on for dear life type of charts. I don't know if it will get back to all-time highs or not, or whether or not it will put in an oversold bounce and collapse. But I think it's one of those that potentially, quick 10, 20, 30% move to the upside, and then take profits, manage risk very, very closely. That would be my stance. Microsoft put in good earnings again during the week, and one of the things I like to do when we have these deep pullbacks in great stocks like Microsoft is just switch over to a weekly or monthly chart and just figure out where are decent buy points. And the 50-week simple moving average has historically been a decent buy point over the last 6 years, and ultimately that looks like it's holding firm again. Again, where does your thesis start to fall apart? Well, it starts to fall apart if you start to break below the lows and below the levels highlighted. So I think Microsoft is probably a buy at this point. I think Amazon, I think there's a potential here if we get the market putting in a rebound in technology names. Of course, Amazon, huge consumer discretionary. If there's a rebound here, I think this would be a logical level for it to do so. Potential failed breakdown, and again, I think we can reasonably expect some kind of bounce, given that RSI has reached an oversold level. Nvidia, again, switching to the weekly chart. One of our members highlighted that the 50-week simple moving average has been hit this week. So again, it could be a decent buy point for those of you that are looking to buy the dip in a name like Nvidia. To the other side of things, again, some of the charts that I've been communicating to our clients over the last few weeks are names that have been holding up very, very well. AbbVie is one of those. We've got Antero Resources. I'm sure it's not escaped anybody's attention about the natural gas supply issues, the prices rocketing higher, etc. Now, this is a chart that I've been covering for our clients since it broke out here at $5. It's been in a 200 SMA uptrend ever since. Of course, it's base breakout. That's the chart that I sent out last year when it was breaking out at $5-6, and the thing has just been an absolute rock star for anybody holding. So again, I think it's building another base, and it's very difficult to be bearish on a stock like this when you've got natural gas obviously ripping higher. Again, another one of those names that has been holding up unbelievably well over the last couple of months is CF Industries. I actually put this out in October in our social media analysis. Obviously that's an inverse head and shoulders pattern, and it's off and running and doing very, very well for many of our clients and members that are holding. PayPal, on the other hand, is breaking down. For those of you that I guess that are maybe new to my work or maybe don't follow my work as closely, a few months ago I put out a piece of work about the Bitcoin Lightning Network and how it was disrupting a lot of the payment processing companies like the PayPals, like the Square Incs, the Visas, MasterCards, etc. PayPal is one of those that is obviously been taken out to the woodshed and been absolutely destroyed. That said, what I am noticing here with the chart is a potential bullish divergence. Now, picking bottoms is incredibly difficult. So for me, if you are in the camp that you're looking at potentially buying the dip on a great company like PayPal, and you think the disruption with the Bitcoin Lightning Network is a lot of nonsense and all the rest of it, something you might want to consider is potentially buying the stock, but understanding that, there has to be an easy get out. If you start to break below the lows of, for example, the 21st of January, then that would be a signal that maybe it's not the bottom in PayPal, and maybe you don't want to take any chances. For disclosure, I've actually had this level here above $200 as my own personal entry into PayPal. That would be a signal to me that would be the bottom. Yes, you are paying a little bit more for the stock, but you have the peace of mind of knowing that there is the bottom is probably in at that point. And I think if it can reclaim that Fibonacci retracement at 50% retracement of this move higher, then that would be an entry signal. But for those of you that are maybe looking at it at the moment, there are a couple of technical signals that might suggest a bottom, but of course you have to 1000% understand where your thesis is wrong. Facebook, again, chopping about sideways, doing a whole lot of nothing. It is at the lower end of technical range for me. So for many investors, many technical traders, technical investors, whatever you want to call us, this is often a decent buy point. I think earnings is, of course, going to be key for Facebook and where it goes in the short term. So I'll be watching earnings with a lot of interest. For disclosure, I also own Facebook, Meta, whatever you want to call it. Google has been struggling at a very key Fibonacci level from the 2007 mark, 2008 crash. This is a level I've been highlighting. I think if it can get above $3,000, I think that would be the signal for me that Google is looking like an entry. Now, INMD is very, very interesting to me at the moment. And the reason for that, this level here, the $100 level now, to our clients and members a couple of months ago, I was just highlighting that this is potential signs of exhaustion. You're running into the $100 brick wall. You've got a bearish divergence, maybe time to start thinking about profits. Since then, of course, the market has fallen off a cliff, and I don't hold that against INMD in any way, shape or form. I think it's a great company. I think the fundamentals are there. It's still a reasonable PE, decent, solid earnings growth, etc. And we've pulled back to this level around $40. Now, for me, that's a deep pullback, and I think if you're in the camp that you'd like to buy in INMD and you're in the camp that the market is going to rebound, we've got a technical support level, we've got an oversold bounce is reasonable to expect, and there's a very easy get out. If you start to break below $38 per share, then that would be a big problem for me. It probably tells me that we're heading to 31 or 26. But if you are in the camp that you'd like to explore INMD, on a great company, might be a level to keep an eye on. Airbnb, looking at this level around 130 as a potential entry. AMD, massive pullback, one of those that's obviously declined 50 odd %, and again, using the 50-week simple moving average. We've got Pfizer here, looking like it's breaking out, and again, it's one of those names that's holding up very, very well. We've got HD, Home Depot, pulled back, 200-day simple moving average. We've got a historical support level. There's been a massive rebound here, so maybe Home Depot is one of those names that maybe you like, the big mega caps. Obviously the fundamentals are all there, and might be one of those that's quite attractive. Again, consumer staple name like Pepsi is holding up very, very well. It's pulled back to logical support levels and looks to be catching a bit of a rebound. Maybe one of those speculative names that could potentially come onto the radar. Now, I posted this to social media, I think on Wednesday or Thursday, just saying that this is going to be a big level for a stock like Roblox. Now, I think there's a potential here for a failed breakdown and a move higher. Now, again, we'll need to see how this plays out next week. It has broken down. RSI is obviously massively oversold at the moment. So I think if we can get back up above $61, then that might potentially be a catalyst for entry. But if the momentum does not come in on Roblox, but when we have these failed breakdowns and they don't rip higher, obviously creating a bit of a short squeeze, then that's oftentimes a signal to just leave the stock alone. So again, Roblox might be interesting to some of you out there. Micron Technology, I think it's probably building a base at this point, or potential double bottom. I actually sent an alert out to our clients and members if this was to get above $100. It obviously couldn't get there. It found resistance exactly where you would expect it to find resistance. So if we get a pullback, I like it at 66 or above 100. I'm looking at JP Morgan as a potential failed breakdown entry. Halliburton, this is one of the names that's been provided to our clients and members at the start of the month on a breakout above the 200-week simple moving average, and it's of course done very, very well. I think it's up 20-25% or something. And yeah, I think, you know, if you're in the camp that energy is going to continue to do well, Halliburton you'd expect to do pretty well too. Now, for disclosure, I put out this to our clients and members a week ago when we broke below the 200 moving average. I put out a short thesis, and on Friday I highlighted the $100 level as a profit taking level for those that had taken the short trade. Now it's obviously rebounded from the $100 level. It is currently a bearish chart, but again, if we start to break out and we can get above that 130 level, again, I'd be looking at that as a potential short squeeze, failed breakdown, and that would be a potential entry for me. We've got the steel index showing a lot of weakness at the moment. Now, for those of you maybe new to technical analysis, the more times a level is tested, the more likely it is to break. So we're putting in here a bit of a head fake, and we're continually testing this level here. And if this starts to break down next week below $50, I think the steel index is probably a short. Again, put out this chart to our clients and members and social media last week, that the lithium names are showing a lot of weakness at the moment. We've put in a bit of a head and shoulders pattern, and we've broke below the 200-day simple moving average. We've got Travelers Company holding up, one of those names that's holding up very, very well. Again, solid fundamentals. We've got Vail SA, again, it's holding up pretty well at the moment. I have applied just a trailing stop loss on this on my position, and looking for this to hopefully move higher. SOFI, been approved for their banking charter, doesn't seem to have made a lot of difference to the stock price. It's obviously one of those names that's aligned with growth and tech. There's not any fundamental data yet, PE ratios, etc., but it has pulled back to its IPO lows, and I like it provided it stays above $10. Continental Resources, I like it very much above 56. Again, solid earnings growth, favourable PEs, etc. We've got Snowflake, pulled back to a logical support level, great company. And when we get RSI reaching these kind of levels, we do tend to get a bit of a rebound. And we also have Coles, again, above $65. Again, solid PE and solid 12-month earnings growth. Now, hopefully you've got some value from the analysis. If you are somebody that maybe struggles with the market, maybe you've had a tough time over the last couple of months, feel free to stick around for a minute or two. But like I said, if you've had some value from this, please do just give the video a like and give it a thumbs up and share it. Let me know what stocks are on your radar and maybe what stocks you'd like to see if I put out an analysis sometime next month if I find some time. But if you are somebody that maybe struggles with technical analysis or maybe the markets in general and would like to know a bit more, feel free to go and jump on our website at honeystocks.com. We provide memberships where I, of course, provide my weekly analysis to our clients and members every single Saturday. I provide a bite-sized halftime analysis on a Wednesday. I provide trade ideas. I'll show you what that looks like in just a second. I provide access to a wonderful community. I provide charting support on a day-to-day basis. If you are somebody that would like a second opinion on a stock chart, then I'm happy to provide mine's any time. You also have full access to my chart book for all the individual sectors. And if you are somebody that would like to learn technical analysis, I'm told that I've built out a very good technical analysis program, which I include with all of our membership plans. And again, feel free, go and check out the work that I put out before the market crash. That's a real-time analysis. There's not any magical hindsight indicators that were used in that analysis. It was provided a week before the crash. So let me just show you what my work looks like. I think this is a recent alert that went out for Lithium Americas. I think it got as high as 38, 39. Cloudflare was an absolute massive winner. That got as high as I think 170. Square Inc. last year hit our upside objective. Of course, the stock price now is a different story. Zscaler was a massive winner. There's Antero Resources, which like I said, I've been covering since that breakout there. But massive winner. Plug Power, I think it was like 300-400% or something as well. So I'm very, very unique in what I do. I record every single trade alert, my high conviction investment alerts that are sent out to our clients and members. I'm not calling out 10 trades a day. I generally send one high conviction, sometimes two high conviction ideas a week, depending on the market, of course. But very much have a quality over quantity approach. If that approach mirrors your own, you might get some value from my work. But have a look at the stocks that I like to recommend, and if that fits your profile, again, feel free to explore our options. But I'm not calling out penny stocks. It's all quality names that are in sectors and areas of the market that I think are poised to move higher. And I've done this for the last 3-4 years, so feel free to go and scrutinise that. But I think if you are somebody that has a mid-term approach, maybe you're looking weeks to months out, maybe you're looking to learn technical analysis, or maybe you're just too busy with work, life, family to keep on top of the market like us professionals do. Maybe you're sick of hunting around social media, or maybe you just want to be part of a community that's all in it to win it, so to speak, then again, you might find some value. But I can't say it any more than what my clients and members, this is Dan, who's taken a 55k account to 650 since March 2020. Now, that is not typical. I'm assuming there's a lot of heavy options involved there, but that's an incredible performance. Sean absolutely enjoyed the service and all the hard work, and look forward to many more years. Got Nick, member for life. Got again Rocco, very, very happy, loves the community, etc. And Vince, up over 100% for second year again, options, profits. These are real clients, real members, real results. So if you are somebody that's stuck around to the end here, thank you very, very much for watching. Feel free to go and check out our website, and don't forget to hit the like button. Thanks as always, and hope to welcome you soon. Thanks.